Four struggling big name stocks that should rally this earning seasons according to Evercore. Good day everyone, welcome to the video of the day. So Alphabet, Netflix, Booking Holdings, all down double digits from the recent highs and all names everyone recognize. One Wall Street strategist says that this earning season is exactly when they turn around. Here's the actual case he is making. So let's start with it. So the setup, because why these stocks are struggling, would be the first part of discussion for us. So let's start with why these names have been beaten down. With Alphabet, it's like the other big tech hyperscalers. A scheme under pressure as massive AI spending and rising debt issuance have started to unnerve the investors watching the balance sheet. For Netflix is down more than 40% from its recent peak, largely tied to fallout from its failed bid to acquire Warner Bros. Discovery. For Booking Holdings is down by 23%, hurt by geopolitical headwinds, the Iran war, and the related travel disruption that knocked the travel sector broadly. Evercore ISI strategist Julian Emmanuel called this some of the biggest and level loved stocks for 2026. Now, we would be discussing on the case for the reversal for the stocks. So here's Emmanuel actual argument for why earnings season flips the script. He expects companies to beat earnings per share forecast by 7% this quarter, more than the double the typical beat rate from down the pandemic. Record AI investment is a major reason he raised that Evercore's full year S&P 500 earnings estimate by more than 6% from $310 to $330 per share. And the bigger point that is in recent poll, 69% of Evercore's clients said that expect the AI spending cycle to last another 2 years or more. To put the earnings growth in perspective, Emmanuel notifies that the kind of profit increase you'd normally expect from economy recovering out of a recession, not a mature bull market. And his year-end target is that S&P 500 finishing at $7,750. Now, the screening method, which is used largely. So this isn't just a vibe-based call. Evercore actually screened for it. They look for companies with above sector earnings estimate revisions for 2027 plus a track record of at least 7 double beats, beating both revenue and earnings estimates over the past 8 quarters, with no more than the double miss in that stretch. Alongside Alphabet, Netflix, and Booking, that screen also surfaced other well-known least loved names, including Nvidia, Skytracker, ADP, Moody's, Kintes, Nasdaq, and Exxon Enterprise. Evercore's read on the broader mood is that sentiment around tech right now looks about as cautious as it was heading into the quarter one earnings right before the same caution set up the rally when results beat expectations. Now, why this is very important for the investors? This is not a financial advice, but here's the framework. This is a bet on specific pattern. Quality companies that have been sold off for reasons unrelated to their core earnings power heading to into quarter where the bar for beating expectation has actually gotten easier to clear because sentiment is so negative. If you're watching any of these names, the actual earnings report matters less than whether they bid by meaningful margin. Emmanuel's whole thesis depends on bid being strong enough to shift the sentiment and not just technically be positive. To conclude, they are beaten down stocks, a strategist calling for a bar low enough to clear, a specific list built from an actual screening process, not just a hunch. Whether it plays out or it starts lending this earning season is very important to watch out. So subscribe this channel, make sure you like the video, share with your friends, family, colleagues too. Welcome to Money Brief. Let's grow together.